I mean, I think that the interesting perspective, however, is that's a very domestic way of looking at the market, thinking in terms of the long-term cost of debt. Of course, that's true for the people who are sourcing capital here and using debt. I think the interesting thing is that a lot of the capital that we see moving around the world is heavily equity-focused. I think if you look at the level of yields that we see in the market, if you look at that outlook that you were putting forward, admittedly, you know, Sydney CBD looks strong relative to other parts of the market, but, you know, that's sending some pretty strong signals, and I suspect that if it wasn't for the strength of your currency, I think that we'd be seeing even more aggressive investment activity coming in from outside. I think there is a different view being taken by international investors who are possibly more optimistic about the market.
Yeah, that's right. I mean, we're taking a very cautious view. There's sort of the per annum rates of yield compression that we see over the next few years are around 15% per annum. It's almost sort of imperceptible in a way, and certainly in a market with low trading volumes. But this chart shows you the per annum average yield compression through the last tightening cycles, right back to the early 80s. And you can see the one that we're forecasting is perhaps we think will be the mildest and the longest too of all the ones over the last 20 to 30 years. You know, the quickest compression was after the biggest downturn in the early 1990s. So in some ways, we didn't have a massive downturn, and we're not going to have a quick bounce back either on the yield compression side. What does it mean for the office market outside of the CBD? Well, I think broadly the fundamentals in the suburban markets are in reasonable shape, and they're pretty much tracking what's happening in the CBD, and that vacancy is falling. The supply pipeline is largely under control and very much controlled by the need to pre-lease any major new developments. Investor sentiment, though, we know is very low in the suburban areas, and will take recovery in the CBD before an improved sentiment spreads into the suburbs to start to see a proper value rise in that area. But there are some other things starting to emerge in the suburban areas, partly generated by the new state government. Obviously, the North West Rail Link, we think, holds the potential to really reinforce that sort of office sector from North Sydney through Macquarie Park and right out to North West as a sort of dominant suburban office arc, if you like. And of course the NBN, which has sort of sneaked up on us a little, but the National Broadband Network, we think, really does provide the opportunity to free up business location in the longer term. And we think it really could provide a great opportunity to corporate location, especially outside the CBD. It's one to watch, and we don't fully understand it. But what we do know is that when the internet gets involved in something, change happens very quickly. And we're seeing it in online retailing as well. So that's certainly an issue we'll take a closer look at in the next 12 months or so. This chart summarises our forecast view of the various indicators through the suburban markets, but ultimately the vacancies are coming down in most markets. And in Parramatta, we think even though vacancy might be rising some in the short term, the new quality grade of buildings going in there should give a lift to rents in that market as well. So even though it's earlier in the process of rental recovery with quite low levels of growth, we think the suburban markets are now also headed in the right direction. What it means for total returns, if we sort of summarise our forecast view of the various office markets around metropolitan Sydney in this chart to show you how they're ranked. Of course, Sydney CBD total returns get a super turbo boost in the next 12 months because of that reduction in incentives in this market. And we're forecasting a total return number of over 20% in 2012, thanks to the combined effects of the slight yield compression and very strong rental growth on the effective side. Whereas the suburban markets, we think, will be coming back to a more typical long-term returns around the sort of the 10 to 13% mark through 2012. Let's turn to the industrial sector now. We think industrial's following a similar path to recovery as the office sector has. And we've certainly seen a turnaround in all of the right areas of the fundamentals. We're seeing leasing demand has improved. That's no longer a forecast. Leasing demand has improved. Construction activity has picked up. That's on the pre-leasing side as well as the speculative side too, which has been handled quite successfully. So there you see it in that chart. So definitely a turnaround back to sort of more longer term volumes of construction activity. And we see a big pipeline of construction potential still in the industrial market, all of course, well, mostly subject to pre-lease, but still around 7 million square metres of industrial stock yet to come online potentially in the industrial sector. So we think it's a market that's worthy of some rental forecast. We think rents have stabilised in the industrial sector now, but it's very much driven by the strongest locations. Again, the occupational side is coming back to the prime market, just like the investment sector is. And we're seeing in that arc, here's the other arc that joins the other one, from Port Botany around through the M5 corridor and around to the outer west, is really the strongest locations for the industrial sector. And that's where we're starting to see rents just starting to rise over this last 6 months or so. And our forecasts call for really a return to the sort of incremental sort of growth in rents that we do typically see in the industrial sector. Now, the investment market in industrial is probably the most extreme in terms of the low levels of investment activity we've seen in the last year or two. I guess we're not sure where the stock's going to come from. That's probably the biggest issue facing the industrial sector for the year ahead. Now the REITs have sold off most of their portfolios from that sector, out of that sector. Is there enough stock likely to come out of the private vendor market to keep the sector ticking over and getting back to average? Unlikely, I think, but the yield compression we think in this sector is likely, and we're forecasting about a 30 basis point compression over the next 12 months and onward. We think it's a sector that's worthy of that, simply because of the improvement in the fundamentals in this sector, despite anything else. The interesting thing about industrial, we often used to talk about the influence of transport infrastructure in either generating development or opening up new areas, or even creating some redevelopment opportunities. And we've been monitoring transport infrastructure that specifically influences the industrial sector for about the last 10 to 15 years. We recently looked at the next 10 years, and we're tracking now about $40 billion of infrastructure projects. And this chart shows you where they will be, where they have been and where they're going to be. And it's interesting that Queensland and Victoria continue to put forward more projects, which are more likely to stimulate the industrial sector than New South Wales is. And this is a key area where obviously New South Wales needs to catch up with the rest of the country. And the projects that are underway, though, or likely to occur in Sydney, will definitely reinforce that industrial arc we talked about, from the Port Botany expansion through to the M5 expansion, through to the South Sydney Freight Line, and right around to the Erskine Park Link Road. So all those things are now proposed and likely to happen over the next 10 years, and will reinforce that arc of industrial activity in Sydney. So the year ahead, we think the total returns for the industrial sector will largely mirror those of the suburban office market and get back to around about that sort of 10 to 13% total returns as we move through 2012. Let's have a look now, just to finish up on the retail sector. Now, we said a little bit different in that office and industrial are certainly on a solid path to recovery now, but retail still certainly has some issues around it, both cyclical in the way of low consumer spending, and some structural changes. And I guess those two things are happening at the one time to make quite a big impact. The structural changes, the sort of things we're seeing is obviously increased in online retailing, and very much an introduction of global retailers who are starting to shake up the local industry. I mean, it's interesting that despite a low cycle in the retail sector, companies like Apple, Zara, Costco can come into the country and be hugely successful. So I think it shows us that it's not just about the statistics, but there needs to be a bit of a shake-up in the merchandising and the way in which products are displayed and brought to the market. And that may lead to more of a recovery than just a cyclical one. We know that Sydney has got itself in a situation now where the retail market, certainly around the CBD here, is about the third most expensive in the world. And we do a lot of global tracking now of these various sectors, and the rents in retail have been on a 20-year cycle. They've been increasing for 20 years. So it might be due for something of a shakeout over the next year or two. Certainly we're seeing vacancy rates rise now in the retail sector here in the CBD, driven by the combined effects of a low consumer spending, as well as the opening of Westfield, sucking in tenants and creating the sort of the vacancy in the donut, if you like, around the mall. And so this is where I think the stress is going to come on the CBD, especially in the retail rentals around the mall, not so much in the mall, where it's still a very strong location.